Jay Clayton has made a centerpiece of his administration or his commissionership efforts to make it easier for companies to go public. Made some proposals yesterday. They're modest, but would you agree something needs to be done? We had 8,000 companies 20 years ago. We've got less than 4,000 today, publicly traded companies.
Yeah, absolutely, Bob. I agree that this has been a problem that's been brewing for several years as companies just found public markets less attractive. And it's a lose-lose when that happens to the markets, to the companies themselves, and to ordinary investors who would ideally like to be able to invest in America's most exciting new and growing companies.
So why is it less attractive to go public than 20 years ago? We always say the big year was 1999, but that was the dot-com revolution. But really, there's been no effort to have big IPOs pushes. Is there too much regulation? Is it too attractive to stay private? Why are we having this dearth of IPOs?
I think it's a mix of factors. Certainly legislation has had an impact, an adverse impact. You had Sarbanes-Oxley, which did a lot of really good things, but made it much more costly and many more hurdles and personal responsibility for CEOs and CFOs and outside audits of internal controls. They're very expensive. That began to deter particularly foreign companies coming into U.S. markets. Dodd-Frank added more things to the top. Some of the activity of institutional investors in the ESG, the social and environmental governance area, incessant proxy challenges, shareholder proxy votes. Each of these things individually can be very good. But when you add them all up, the donkey sometimes has trouble carrying the whole load.
You're discussing the regulatory aspects of this, but isn't it just easier to stay private? It's easier now in the last 15 years or so to sell private placements to qualified individuals. The law changed a while ago, so you can get these qualified individuals into these deals in a private way.
Well, that's another piece of the puzzle, that there's more money that has allowed the so-called unicorns to get far bigger than would have been true 20 years ago before they have to go public for capital reasons. Shareholder litigation is another deterrent. So, you add together all the things that disincentivize people from going public. Now, obviously, there's some big incentives, too, if you can raise a lot of capital.
The final thing I would bring in, this is David's territory, is mergers and acquisitions. It seems like it would be a more attractive option. If I'm a small company, I've got these giant companies, these Ciscos and IBMs out there, wouldn't I look to have them buy me rather than go through all the effort of going public? Isn't that an easier route at this point?
Well, easy. I think your valuation will be much higher if you grow and maximize your technology, and you may someday be the subject of an M&A transaction, but do it at a much higher number and a much bigger premium. So it's the deck is not completely stacked against public companies, but I think Jay and his colleagues are doing a wonderful thing in focusing on this and saying, hey, we don't want to hurt investors. We don't want to do anything that opens the door to fraud and selling stock by tweets rather than by good information. But let's try and keep it in balance.